Hello and welcome to Trading Hour. I'm Ekta Batra and with me is Sonal Bhutra. Well, we're filling in for the normal anchors for the show, but nonetheless, it is a great day to fill in for it, considering that we have the Nifty sitting at around 25,000 at this point in time. So we've crossed that milestone mark and we have a lot of statistics coming your way in terms of what you should probably see and which are the stocks which have really led the rally as well. But just want to point out that, Sonal, it's been so interesting because we've waded through so many negatives for the market. The election verdict, the capital gains increase, as well as maybe even earnings volatility to a certain extent. And despite all of that, we're sitting at that milestone level of around 25,000. And not to mention that, the DIIs are really pulling their weight at this point in time. Just a small piece of evidence is in just the past 7 trading sessions, we've had the DIIs pump in around 24,000 crores and consecutive buying coming in from there. FIIs have been net sellers in 6 out of 7 of those trading sessions, and they've net sold around 19,000 odd crores in the same period. So net, the inflows have also been positive, and now the weight is obviously towards the DIIs.
Absolutely. And DIIs not only directly in the equity markets via mutual funds. We've been talking about the SIP number as well.
SIPs.
So it's been a one-way move there. And right now, mid-caps which have been doing well, they have come under some bit of profit booking. So that index is down 132 points, but so many movers in the broader markets. The biggest news, of course, being Nifty touching that 25,000 mark. It has come off from the highs, but we'll have to see whether that stays above that milestone or not. But as we've been talking about Nifty hitting the milestone of 25,000 and taking 24 sessions to gain the latest 1,000 points. Mangalam is tracking the journey to 25,000. Mangalam, take it away.
Well, 25,000 is actually just a milestone in what is otherwise a long journey for the Indian equity markets itself. So I just thought it's a good time to look back and track that journey itself. The index started in April 1, 1996 with a base of 1,000. Over the next 11 years, in September 2007, it moved to 5,000. Between 96 and 2007, we of course had the IT boom, the IT bust, the Asian financial crisis, the big bull run as well. And then from there, we had the great financial crisis of 2008. Between that and 2017, the Nifty doubled again to 10,000. Thereafter, in quick succession, it moved to 15,000, 20,000. And now as we speak, we are sitting on Mount 25,000. Between 10,000 and 25,000, we've had GST, we've had demonetization, we've had a couple of elections, we've had a couple of wars, we've had the major pandemic as well. But the cult of the equity market and the market kept moving on. So what it teaches you basically is that over the long term, irrespective of the events that are taking place in the near term, the Nifty has compounded at 12% since inception. What does this mean? It's doubled every 6 years. And what does this coincide with? For the last 23 years, the Nifty EPS itself has compounded at 12%. So whatever happens, if the earnings are moving in a certain direction, the market eventually will catch up. So at 25,000, the index trades at 22 times FY25 price to earnings. This is something that we will monitor going forward as well, irrespective of, again, the events. The last 5,000 points is what we're tracking right now in terms of moves. They've been led by, the PSE index, the public sector enterprises, the realty stocks, oil and gas, as well as some of the auto stocks as well. What hasn't participated as much in the last 5,000 points has been the IT index, the FMCG index, and the Nifty Bank, while they've moved, but not to the extent of the others itself. It's been a broad market rally. So SME IPO index is up 165 points. Small cap and mid cap indexes up anywhere between 40 to 50% itself. The top Nifty gainers, Bajaj Auto, Coal India, M&M, ONGC, basically IT, Realty as well. You have PSE's Realty and the others. And if you look at the underperformers there, Bajaj Finance is actually down 8%. Asian Paints, IndusInd Bank, HDFC Bank, the biggest of the banks, down by about 1% over the last 1 year or so. But I've said it's a broader market-led rally. So we have Oil India, NBCC, Trent, all of them nearly trebling in the last 1 year or so. Oracle, Amara Raja up 150% as well. And here too, we've had a couple of notable losers. Z down 50%. We've had Naveen Fluorine down 20%. PVR Inox down about 15% as well. With all things said and done, as we sit atop Mount 25,000, what are the things that we are tracking going forward? One, will FIIs return to buy in cash market? This has been a largely DII-led rally. Second, now with the outperformance of the mid-cap stocks, is it time for large caps to take the baton and move forward? The third thing that we're watching out for is increasing retail participation and domestic SIPs. Does that continue in wake of all the regulations that are coming by as well? And finally, there are a lot of pockets of hefty valuations in the broader markets. Do they go away or not as well? And we obviously cannot discount the impact of geopolitics and global developments more on the market. So those are a bunch of things that we'll be watching out for from Mount 25,000.
Okay, Mount 25,000 it is. Thanks, Mangalam, for that comprehensive take and the compounded rate at which the Nifty has in fact grown, irrespective of all of the events that have taken place, which might be negative. Manish Jain from Centrum now joins in to discuss the market fundamentals and his top sectoral picks. Manish, hi, welcome to the show. Well, it's a milestone event, 25,000 here for the Nifty, but the big question is that should one probably take some profits off the table now, or should one continue investing? Do you think that valuations have now become a little punchy and it might just be prudent to have some cash?
No, I don't think so. I think the markets will continue to rally from here onwards also. So there are three things that continue to play on my mind. See, one is that most of the big events that had to be played out have kind of happened, right? So the elections had to happen, the results are out of the way, the budget has happened, kind of a mixed bag, but it's out of the way again. So there's no overhang which is left in the market. The monsoons have been progressing fairly decently well. The rural growth, the volume growth, especially in the FMCG sector, has now started showing some green shoots of revival over there as well. We saw the quarter from HUL where they reported about 4% volume growth. So that has again been going well. So most of the larger events are kind of out of the way, which is point number one. Point number two is that we are still holding on to the estimate of about 12% sort of earnings growth as far as Nifty is concerned over the course of this year and the next one. So that means that on a 1 year forward basis, Nifty will be somewhere in between 21 to 22 times P multiple, which is not exactly in a very expensive zone. Bubble starts getting formed when it's about 23, 24 times. And then liquidity is just so strong. The domestic liquidity from retail investors, the SIP money, 21,000 crores a month, is just so strong that given the fundamentals of the economy, when you look at the budget, the kind of fiscal deficit numbers, government borrowing program, rate cut is kind of on the horizon, I don't think the markets is going to experience any major correction anytime soon. So I would expect, I would advise people to kind of continue investing over the course of next few months.
Manish, you're talking about more investment opportunities still available. I was looking at some data. The Nifty small cap PE is at around 22. The average PE has been around 15. The Nifty current PE around 20. And the average PE has been around 18, right? So there is still a premium that these indices are trading at. So in a market like this, where do you find opportunities where you can trade? What are some of the sectors you think would still see an upside potential from here?
So the thing is that, see, one is that the data you provided is absolutely right, which is if you look at the long-term average, Nifty is traded at around 18 times versus now where it's trading at close to 21, 22 times or somewhere in that range. But the point is, if you look at the last decade, which was 2010 to 2019, 2020, the average earnings growth from Nifty was about 6%. So we were paying 18x multiple for that, which is roughly about 3x PEG. But today, the same Nifty is delivering double-digit earnings growth. So it's less than 2 times PEG, right? So when systematically the ROEs of a market moves up, when the profitability moves up, when the overall leverage in the system, as far as listed equities are concerned, kind of move down, then the multiples will be at a slight more premium as compared to the last history. So that's not what I'm worried about. And second is that when you look at autos, when you look at banks, even the larger 4 or 5 banks that trade in the market, what you realize is that the rally has not been homogeneous in the last 1 year. Not every stock in every single sector that has done well has kind of participated. It has been a very concentrated rally in some of the sectors, in some of the stocks. So if you do a very strong due diligence and have a bottom-up approach to investing, you'll still find enough investment opportunities. We continue to be very, very constructive on IT. We continue to be very, very constructive on the consumption sector. We continue to be very, very constructive and overweight on the real estate sector at this moment. Banks probably not as much, but NBFC is definitely, again, very, very positive in that sector. And again, pharma will continue to see some bit of a rally again going forward from here.
Okay, just quickly, Manish, I wanted to specifically narrow down on the Nifty PSE index. As Mangalam was pointing out, it's gained around 95% since September of last year. And the big question is, should you be putting more money into such stocks and within that index? what is your sense? Do you think that the run-up has been far too great there and one should probably stay on the sidelines?
Yeah, so it's not just Nifty PSE, but when I look at defense stocks, when I look at some of these stocks in the construction, in the infra side, when I look at some of these manufacturing names as well, the same question kind of comes into my mind is that whether these stocks are kind of running ahead of their fundamentals. And at this moment, these are the sectors where we are kind of sitting on the sidelines. We are not taking fresh bets, but we are not taking money off the table where we had been invested historically. So that's the approach we are kind of taking. So definitely in terms of risk versus reward, these sectors have definitely seen a very significant run up as compared to what the near term or even the medium term earnings growth are over there. So any kind of correction over there, time correction also, I'll probably start looking at it. But at this moment, kind of sitting on the sidelines, definitely.
Okay, all right. Manish would have liked to chat a little bit more, but out of time, a lot of moving parts in the markets today. But thank you so much for joining us with your take. That's the market advice. But let's get to a CNBC-TV18 exclusive now. We learned from sources that KEC International is the likely front-runner to acquire promoter stake in ITD Cementation. Yash is joining in with all the details. Yash, what are you picking up?
Well, Sonal, it was just last month when the promoter entity at ITD Cementation, that is Italian Thai Development Company, had informed the exchanges that the promoter's intention is to divest their investments in the company. What I'm given to understand is that the process to do that started right after that. There were certain players which, of course, the promoter entity and the entity itself, ITD Cementation, was in talks with, and sources have told CNBC-TV18 that the company started its conversations with a single player here, and that is KEC International. Of course, as I said, the input is also there that there were a couple of other players. One was domestic. There was a foreign player as well in the race to acquire this particular stake, but at this point of time, the input that we have is that the company's started its conversations with one player, that is KEC International. The promoter, that is Italian Thai Development Company, owns about 46.64% stake in ITD Cementation. As far as that particular valuation for this particular transaction is concerned, that is expected to happen at the current levels itself, that is at a market cap of about 9,000 crore rupees, which means that the 46% or 47% stake which the promoter holds and is willing to sell, the value for that stake, which KEC, if the deal itself fructifies, KEC will have to pay about 4,000 to 4,500 crore rupees for that promoter stake acquisition. As far as order book is concerned, KEC International holds an order book at the end of FY24 at about 37,000 crore rupees. ITD Cementation has an order book of about 20,000 crore rupees at the end of FY24. And since the conversations between the two players have started, what we've been given to understand from our sources is that there is a possibility that the deal could be announced at the end of September or the start of October itself. We've written to both companies on this particular query. KEC has said that they do not comment on market rumors, and the company continuously evaluates various inorganic and organic growth opportunities. They will make the necessary disclosures whenever the right time comes, and ITD Cementation has declined to comment on this query.
Okay, all right. But the stock is definitely very active on the back of this news. Thanks, Yash, for getting us that update. ITD Cementation, as you can see, that stock is up around 3%. We'll take a short break, but up next, we'll talk to the first company on the show, Saurabh Agrawal, the Executive Director of Action Construction Equipment, or ACE, to discuss the quarter gone by. Stay tuned.
Welcome back. You're still tuned into Trading Hour. Let's talk about some earnings now. Action Construction Equipment saw its revenue surge 13% on a YOY basis. Margin expansion continued, and this was driven by operating leverage and favorable commodity prices. To discuss this and more, we are joined by Saurabh Agrawal, the Executive Director at the company. Mr. Agrawal, good morning. Thank you so much for joining us. Well, it's been a good quarter for you, this despite the fact that there were elections. But tell us what the outlook is going forward, and what was the breakup in quarter one in different segments? How much was the value growth? What kind of volume growth did you see in each product offering?
Yes, good morning. Last quarter was definitely a little less than our expectation because of the elections, but obviously we had planned for that. And I think we were able to do fairly good enough with a 13% growth on a year-on-year basis. And for our cranes, construction equipment, and metal handling sector put together, I think we saw a decent revenue growth there, about 20%. And there was a degrowth in the tractor segment, but obviously that we've taken care of. There was some really good export orders which were getting executed last year, same time, for tractors. So that's why you see the deficit.
Oh, okay. So your agri equipment was under pressure because of a high base?
High base because of a special export order on tractors which we executed same time last year. I mean, but I'm sure that will catch up in quarter 2, quarter 3 coming up.
So what was the normalized growth within that segment and what are you guiding for?
I think for both the segments put together, I think if I talk of grains construction equipment, we should ideally be looking at least a 15-20% growth in this year. And on the tractor segment, about a 15%.
Okay, 15 to 20% overall and 15% in the agri segment. And how much would exports be? You said it was taken care of by exports to some extent. How much it is as a percentage of your order book right now, revenues as well? And what kind of growth are you looking at just the export segment?
Last year we did close to about 8%. So hopefully in this current year, on a company basis, we should be able to better it. And we are looking at executing further export orders in, it's going to start primarily from end of quarter 2 and going into quarter 3, quarter 4. So hopefully it should be above 8% this year as well.
And how much is export as a percentage of your revenues?
Last year it was around 8%.
Okay, no, I thought that was the growth number. So what is the growth that you're expecting then?
See, again, about a 15-20% because the company is going to go 15-20% and we're able to maintain 8%. So the growth will be around 15-20%.
Okay. All right. So you're quite bullish in terms of growth going into FY25 for the remaining part of the fiscal. But if you want to talk about a maybe longer term journey, you had mentioned that, 3x growth from a base of around 2,500 crores is possible in the next 5 odd years. Does that still stand? Are you on track for that? Or do you think that you could probably, exceed it or undershoot it based on the demand factors that you're seeing right now?
Yeah, I think everything seems to be going on well. And in the long term and even in the short term, the government is very much focused on the infrastructure development as well as the manufacturing sector. So I see no reason that over the next 5 years, we should not be able to, do a 3x with respect to our revenue and profits at least. So things seem to be proceeding as per our plan, and I think everything seems to be going on fine.
Okay, you're sticking to that guidance. Just wanted to ask you, you do have, some plans with regards to a joint venture in India as well with Kato Works. Can you just tell us about where that is currently and what would that JV consist of?
Kato Works is a very prominent manufacturer out of Japan for bigger cranes, truck cranes, crawler cranes, and rough terrain cranes. And this is what we intend to do in India with them. Make machines for the Indian market and as well as for the export market. So we principally agreed to form this joint venture. Hopefully this work should get completed in this year. And we should be able to kick off the joint venture and productionize it in the next year.
What are the terms of the joint venture? What is the holding structure? What would the revenue share for you be? Will you have to make some investments in this particular JV?
Yeah. The percentage holding, both of us will be about 50-50%. And the overall investment which are envisaged is close to about 150 crores.
I'm sorry, can you repeat that?
The overall investments envisaged are close to about 150 crores.
Okay, all right.
Okay. Well, while we spoke about, what you're expecting in terms of growth on revenue, wanted to understand what you're envisaging in terms of margins as well. For the entire fiscal, what do you think the exit rate would be, and specific segments as well? Your cranes, material construction, as well as your agri, what would the respective margins be?
Yeah, I think we should be closing somewhere between 16 to 17% on a company basis, more towards 17%, I would believe. And out of this, the cranes construction equipment handling segment should be around close to 17%. At agri, we should be close to about 4-5% by the end of this year.
Okay.
So you're expecting a margin improvement across the board?
Yeah, definitely.
Okay. That is about the present segments that you operate in. You had also forayed into defense sector. What has the demand been like there? Wanted to understand how much will that contribute as a percentage of revenues this year? Is the margin higher here? We are seeing a lot of order intake.
See, last year we did 2.5% of our revenue actually in defense. And with the current order pipeline in place, it should exceed at least about 3.5% in the current year as revenue share. But in saying this, I would also like to add that we are expecting one of our biggest orders from defense, hopefully within Q2, if it does not trickle into Q3. So that can help us even exceed 3.5% by a reasonable margin within the current year.
How big would this order be?
See, this will be somewhere between 300 to 400 crores.
Okay, 300 to 400 crores, and we could probably hear about it in Q2 or Q3.
Yeah, by end of Q2, but definitely by Q3.
Okay, and just quickly, you had also indicated that you would probably look at inorganic plans in Q2, Q3, which will be outside of the country. Anything you can update us on that?
See, we did have some plans. We still have some plans on, as a matter of fact, but I think they've been deferred. There's certain other developments which are taking place, which I really can't discuss right now. Maybe in due course over the next 1 or 2 quarters, so that it will become more evident.
Okay, all right, Mr. Agrawal. So as and when there are more updates on this one, we'll chat with you again. But thank you so much for joining us today and giving us a sense of what the business is looking like and the outlook going forward. That's Action Construction Equipment. The stock, though, is down around 1.5% right now. We'll do one thing, we'll slip into a short break. As we do that, we are thrilled to announce the College Connect program under our ongoing season of HSBC presents CNBC-TV18 Future Female Forward, the Women's Collective, recognizing college students as the leaders, opinion makers and change makers of tomorrow. The unique initiative encourages the youth to foster inclusive and diverse workplaces, drive gender parity and tackle societal and business challenges when they join the workforce. We are kicking off at IIT Delhi on August 3rd from 3 p.m. onwards with some of the biggest leaders and voices joining us. Stay tuned for that.
Welcome back. Well, stable for the market, so no problems coming in there. But let's discuss one of the big stocks of the day, Infosys. It's faced a demand notice from the DCGI and the Karnataka State GST authorities for tax evasion for a period from July 2017 to 2021-2022. Surbhi is here with the details on this.
Well, thanks for that. Indeed, Infosys has received 2 pre-show cause notices, and the demand in question, or the amount in question in the notice that it has been served by the Karnataka State GST authority is 32,403 crore rupees. There's also a notice by the DGGI, which is the Director General of GST Intelligence, which is a central level body. Now, what is in question? The issue in question really is the expenses which have been incurred by Infosys's overseas branches, whether there is any GST non-payment for the years concerned by these overseas branches. Infosys has responded. In fact, they've given a statement to the exchanges saying that they don't think that they're liable for any of these demands that have been raised, saying the service provided by the overseas branch is not subject to GST. Infosys is citing a circular that was issued in June of this year by CBIC. Therefore, it's saying that these expenses are not subject to GST at all. It's also saying that GST payments are eligible for credit against the export of IT services. Infosys says it's fully compliant, it has paid all dues, and there is sort of no issue at hand. That's what we know right now, but we need to see if this matter will be appealed further.
All right, so that's the update on Infosys. Thank you so much, Surbhi, for joining us with all those details. Let's take a short break now. Up next, Sameer Dheer, the MD and CEO of Sonata Software, will join us to discuss the company's quarterly numbers. Stay tuned for that. Welcome back. Let's talk about more earnings now. Sonata Software saw its revenue and EBITDA margin surge in Q1 FY25. Profit after tax and other income, however, came under pressure. To discuss this and more, we have Sameer Dheer, the MD and CEO of the company, joining us now. Mr. Dheer, good morning. Thank you so much for joining us. Before we talk about the overall numbers, I specifically wanted to talk to you about international IT services, because this is where margins have fallen on a quarter-on-quarter basis by 300 basis points. This is when the wage hikes are expected in Q2. Can you give us a sense of what happened here and what is the outlook on margins going forward, considering that wage hike is still pending?
Yeah, good morning, first of all. And I think the results are much in line with our expectation that we guided for last quarter. We have come in at around 1.3% on the growth side. And on the margin side, our EBITDA for the international business that you alluded to is up by about 1.4% sequentially. So our EBITDA went up from about 17.3% to about 18.7%. So actually the margin has increased on the international business side. On the profit after tax, because we had Forex impact in the quarter, that's why the PAT has shrunk largely because of the Forex impact that we had. But the base health of the business has definitely been very robust and it improved quarter on quarter.
Okay, no, I just wanted to confirm the margin number in the international business. As per the calculations, it's at 18.7%, which compares with 21.1% on quarter basis.
Yes, last quarter it was 17.3. It is now 18.7. It is up.
Okay. All right. So you're saying there's a margin improvement place in the international IT services segment on a Q-on-Q basis. But, you know, sir, it doesn't take away from the fact that it's been a weak quarter in terms of revenue. The reason I ask is that the last quarter you had indicated that, you know, growth would be between but that is lower than what was anticipated by the company at the lower end of the range. So if you could just take us through what took place in terms of the demand factors, what resulted in maybe the pressure quarter.
Yeah, no, I think that's exactly what we anticipated as we were guiding for the first half of the year. If you recall, we had talked about that we are seeing some deal decisioning delay, especially on the large deals. And that factor was going to impact us for the first half of the year. We had guided that second half of the year will be stronger. And in Q1 specifically, the deals, we closed 3 large deals. And one of them is a fairly large contract for over 7 years as well. I think as we ramp up those deals, we'll see an uptick coming through in Q2, but largely in Q3 timeframe. So I think in Q1, Q2, we will still be between 1 to 3%, but we'll see the second half of the year much stronger than on revenue terms compared to the first half of the year.
So Q2, you're still going to be 1 to 3% in terms of growth.
That's right. We'll still expect Q2 to be into 1 to 3%, but we'll pick back in the second half of the year.
And the second half would be what then in terms of growth, considering that these 3 large deals that you've signed will probably start reflecting then?
Yeah, it's hard to put a number, but like you said, for the whole year, we'll be ahead of the industry average. We'll be significantly above the industry average, which we are still very confident that we close the whole fiscal year will be above the industry average overall. And the second half will be better than the first half from a growth perspective. That was our guidance, and we still sustain that guidance. Clearly, within the numbers, we have seen some significant movement in some of the industries. We've seen the high-tech industry come up. We've seen the healthcare industry come up. Of course, there are pressure in the retail side, but these 2 industries definitely come up, and banking has seen definitely some green shoots in the quarter. So we expect in the whole, the second half of the year still is very strong, which is what we had thought about a quarter back.
Okay. So in this pipeline that you spoke about, that retail is not doing so well, but the other spends have been going higher. What is the percentage of AI pipeline coming in here? And in that case, going forward, will you be looking at some acquisitions which would improve your AI pipeline? Anything that is planned in the rest of the year?
Yeah, so we're pretty confident about our AI positioning. As you know, we had launched Harmony.ai platform about a year back, and that continues to resonate well with our clients. And our overall AI pipeline is close to about 60 million. I may not have the exact number right now with me, but it's close to about 60 million or so. And within the quarter, we saw some significant wins. We saw about 9 mid-sized deals that we closed out on the AI side, which is very, very promising. So the POCs have now definitely moved to some early projects. And AI is also becoming an integral part of some of the large deals. The last 3 contracts that we closed in Q1, one of them has an AI platform to be built in the first 2 years for the customer. It's a healthcare customer. It's a 7-year contract. So the first 2 years we'll build the healthcare platform out, and then the benefits from that platform will accrue to the customer in the following 5 years. So AI is definitely an integral part, but the standalone AI, we have closed about 9 mid-sized deals in the course of the quarter as well.
Okay, and what is the pipeline of closing further deals in the AI segment? And also wanted to ask you, you mentioned decision delays. Has that now evened out, and which sectors were you probably seeing that in? What's the status now?
Yeah, so like I said, the overall AI pipeline is about 60 million or so for the company. which is still holding up. I think it's gone up from about 50 million last quarter. So quarter on quarter, not only we've closed 9 mid-sized deal, but we've also added the new pipeline, which is I think very promising and expected based on the investment that we made on the AI side. As far as the deal decisioning is concerned, I think you have to parse it into two categories, candidly. The large deals, I would say more than $10 million type deals are still taking about anywhere around 2.5 to 3 quarters to close out, which was about two quarters or so, maybe a year back. But the mid-sized deal velocity has increased. We're seeing the mid-sized deals close out slightly sooner now in some segments of the market, which is definitely a positive sign overall.
Okay. All right, Mr. Dheer, it was a pleasure speaking with you. Thank you so much for joining us today and giving us all those details. That's the word coming in from Sonata Software. They expect second half to be better than first half. It's time to get you an update on the IDBI privatization. We learned from sources that 3 potential suitors have been given fit and proper certificate by RBI for IDBI Bank. Ritu Singh is joining in with all those details. Ritu?
That's right, Sonal. We understand from sources that there are 3 potential suitors that have received this fit and proper certificate from the RBI for the acquisition of IDBI Bank, and those names include Fairfax Financial Holdings, Emirates NBD and Kotak Mahindra Bank, which have now been given the all clear from the Reserve Bank of India to proceed to the next step. However, our sources do indicate that Kotak Mahindra Bank may not pursue the acquisition of IDBI Bank at this time, given that it itself is undergoing, a transition phase. There's new leadership. It's also in the middle of that tech ban, which has been imposed by the Reserve Bank of India. So IDBI Bank acquisition may not be the top priority as of now. Now, my colleague Sapna Das had reported earlier that the due diligence process for the bidders will start in early August and that the government is expected to call for financial bids for IDBI Bank before the close of the current financial year. Now, keep in mind the government is looking to sell about 60.7% combined stake in IDBI Bank, and that includes about 30.48% held by the government and 30.24% held by LIC. Now, Fairfax Financial Holdings, as we know, has a 40% stake in CSB Bank, and if it does pursue this acquisition and emerges as the winning bidder, then as the promoter of CSB, it may potentially explore a merger with IDBI Bank. In the case of Emirates NBD, however, it will be a strategic acquisition. Now, we have reached out to all of the 3 entities for their comments, which are still awaited. Keep in mind, Fairfax India's public investments include significant stakes in CSB Bank, in IIFL Finance, IIFL Securities, 5paise, among others. And Emirates NBD, on the other hand, operates in India via 3 branches and serves retail, private, wholesale and NRI clients, and has total consolidated assets of a little over 6,300 crores and profits of 60.7 crores as of FY23.
Okay, a big story coming in there, Ritu. Thanks very much for that. But on that note, we need to take a short break. Once we come back, we'll be talking to the management of Sasken Technologies to discuss the quarter gone by. Stay tuned. Welcome back. Well, for the markets just about holding 25,000, we've come off the levels now, but nonetheless, the milestone has been crossed in today's trading session. We're just about higher by around 0.2%. Remember, it's another record high for the markets. We did close at record highs in yesterday's trading session, so we've continued to build on gains despite that 25,000 milestone mark being met. But before we kick off the rest of the show, let me start with some good news. The numbers are out and it is final. India watched Budget 2024 with CNBC-TV18. CNBC-TV18's dominance continues as it knocks out the competition on Budget Day. CNBC-TV18 is the clear number 1 with 91.2% viewership during the budget speech. Yes, in fact, continuing its 25 years of leadership, CNBC-TV18 wins another gold on Budget Day. Thank you, viewers, for your consistent patronage, trust, and continued support.
Few hours away from marking a new record. The CNBC-TV18 coverage of the Union Budget starts right now.
All right. So these are
no
some of the
surprises
visuals.
there.
Yeah, some visuals from the budget day, of course, from the political setup to the big budget numbers to fiscal consolidation, some of the stocks that will be in the focus as well. We got you covered. So thank you so much for joining in for all the expert advices and quick and relevant and accurate analysis as well.
And you always want to stick with the leader on big days, 25 years of leadership. This is where people go when they want to watch that budget speech, want to watch the analysis of the budget, want to watch which stocks are actually impacted. And that's clearly visible in terms of the ratings. So 91% viewership during the budget speech. Those
Sound
are
of victory, right? That is what we would call it. 25 years of CNBC-TV18 and talking about this big number, 91.2% All India viewership during the Finance Minister's speech. So you know where to go on big days and on regular days as well, because we consider every day as very important for our viewers. Every minute, every hour of when you tune into CNBC-TV18 is when we want to make it very relevant and very value additive for you as well. So that's what that day looked like. A lot that happened and a lot that will continue to happen. But that's, of course, the big number that we are talking about.
Yes, absolutely. Our leadership continues through all the big events which have taken place this year, from the elections onto the budget now. But let's move on now. Technology is in focus after reporting, Sasken Technology rather is in focus after reporting its Q1 numbers. While revenue and EBITDA margins surged sequentially, total order wins declined. We have with us Mr. Modi, who is the CMD and CEO of Sasken Technology, who joins in to discuss the numbers, the way forward for the company. Mr. Modi, thank you very much for taking the time out. Well, just wanted to start with the new order wins, actually. They've come off compared to the run rate of the prior quarter. Any challenges in closing deals? And also just wanted to touch base on any kind of delays in terms of decision making, considering that one of the IT companies that we spoke to just before this, Sonata Software, said that there is some amount of delay in decision making, especially for mid-sized deals, which did impact them. So just wanted to get an idea in terms of these new order wins and what the color is there.
Yeah, so morning everyone. Thank you so much for having us with the channel today. Congratulations on you being rated #1 for the budget sessions that most of us watch. On the order book side, I don't think there's any worry whatsoever. It's in line with the plan we have been tracking and executing on. So we had the plan. Typically what happens in this quarter is the new orders are largely booked, but the renewals happen primarily in the third and the fourth quarter. So in our business, we see that as a trend. So no, to answer your question, while order book is 11.4 million, I think we have seen good momentum of order booking happening in our Sasken Silicon, which is the silicon arm that we recently have invested and created in. Similarly, we are seeing a good momentum across the verticals we are serving, largely in semiconductors, in automotive, in silicon design. In Japan, we're starting to see the momentum kind of pick up. So obviously, I think we are bullish in terms of the pace at which the order booking will continue.
Okay, so in that case, Mr. Modi, what would revenue growth and margin outlook be this time around? Just wanted to understand from a pricing perspective, these new order wins that are coming in at, and what does that do to your revenue growth in FY25?
I think we have shown a growth of about 13% in Q1 over Q4. So we have seen a good momentum, and we continue to see a momentum around that. While we don't give guidance, I'm quite optimistic in terms of the growth trajectory that we are on, and to sustain the momentum. While it may not be possible for us to sustain 13% growth, but we definitely continue to see that we'll grow at higher single digits in the coming quarters.
Yeah. Yes, that's what I wanted to understand from you qualitatively, if you can give us an idea, because in the last year, it was a decline. Before that, it was a 3% growth. So it's high single digits that you're looking at in terms of growth in FY25. What about margins? What's the kind of band that you're looking at?
I think the margins primarily, like we said last time also, that once we reach a revenue of about $18-19 million per quarter, we should see about 13-14% EBIT. We continue to recruit. For example, we're going to add 150 new recruits, new freshers in this quarter. We also given salary hikes in this quarter. So we may see some decline in the margins, but we are on the right path in our execution on 60 by 4 by 3, and we are seeing good results around that. We continue to march on that momentum, and we are quite optimistic in the sectors that we are serving, the engagements we have with our customers, and building the growth trajectory, growth momentum.
So how much can the margins probably decline to? You did around 4.2% in Q1 FY25. That was an improvement from 1.9% in the previous quarter. So give us a sense in terms of where the margins would probably be if you are expecting lower margins.
I think I may not be able to give a guidance on that in this, but we may see a decline of maybe a couple of percentage points in terms of the margin in the coming quarter.
Would it be as low as Q4 of FY24 where you did 1.9%?
Because I think, because we are investing in growth, and we are very conscious of the fact that we are signing deals that are accretive, as well as in the long run, it's going to help us. So focus is singularly on growth, ensuring that we are not signing any stupid deals, and we are confident of that, so that we are spending monies below the line on the bench, as well as capability building, and also investing in newer areas, particularly the ones that are impacting or expected to impact the vector of technology innovation. So we're investing in 5G, 6G, we're investing in AI, ML that are specific to, say, instrument clusters inside automotive and in the telematics and those areas, which I think are going to be the vectors of growth going forward for us.
Okay. All right, Mr. Modi, thank you so much for joining us today and giving us all those details. That's the word coming in from Sasken Tech. They expect high single-digit growth in revenue going forward. Margins might see a decline in Q2, but that's largely because of these investments and wage hike as well. Well, with that, we'll do one thing. We'll wrap on this edition of Trading Hour, but stay tuned. Halftime report is up next. A lot of action in the markets. You don't want to go anywhere.